When you're buying commercial properties, you're going to run into a shit ton of documents. And today we're going to be talking about three other important documents you're probably going to see in the acquisition phase of a commercial property. We're going to be talking about estoppels, we're going to be talking about option to purchase agreements, and broker agreements if you're using a broker. So let's get into it. So first up, we have estoppels, or sometimes they're also called estoppel certificates, or for me, I just call them estoppels. These little pieces of paper are going to be your best friends in real estate transactions. What they do is they validate the terms of a lease agreement between a tenant and a landlord. They're making sure that everything is as they say on the lease. Once again, it's about trusting but verifying. Here are some of the key inclusions you want in your estoppels. You want to verify the lease start date. You want to verify the rent payment status. Are they in delinquency, or if all their rent payments are up to date, if there's any defaults by the landlord or the tenant, and you're probably going to see any lease modification statuses. Are there any amendments or any changes with the lease in general? So these certificates are going to be signed by both the tenant and their landlord or their representatives, affirming or attesting that the lease terms are accurate and they're currently valid. It's pretty much a protective shield that offers you reassurance that the lease terms are legit, they're legally binding, and neither party is breaking any rules. This is also going to help you as the buyer to make sure that what the seller is giving you is true, as well as the lenders. It's going to keep them safe. It's going to keep them happy in order to loan on the property. I also have a template for it on my website, which is www.protonprofits.com. I think it's /resources, or there should be a tab for resources on the website for you to check that out. So next up, we have an option to purchase agreement, and it's just like it sounds. This gem is also known as a lease option or a rent to own agreement, which is an agreement between the landlord and the tenant. It's going to give the tenant the right, but not the obligation, to buy a property at a predetermined price within a specific time frame. And in exchange for this exclusive option, the tenant is typically going to have to pay an option fee, and they're going to have to agree to pay higher than market rent in normal terms. During the option period, the tenant can choose to buy the property, but if they opt out, they're going to forfeit that money. But if they do decide to buy it, they're going to have to provide a down payment. The option fee, normally I make it non-refundable, and you can even credit it towards the down payment. There's a lot of creativity that you can do here. It just depends on what you want to do. In general, this agreement is going to offer flexibility for both parties. It's going to allow the tenant to accumulate equity, and it's going to allow the landlord to generate even more additional income. So in these cases, you can be either the tenant or the landlord. If you're looking to sell a property, you're probably on the landlord's side, giving a tenant the option to purchase your property. Or if you're on the tenant side, hopefully you're on the master tenant side. Or if you're leasing a space and you want to purchase it for use in the future, this would be a great agreement for that. So I'll paint it for you in an example. Let's say you're eyeing a strip mall, but you can't buy it outright. So you propose to the seller, you're saying, hey, I'm going to do an option to purchase agreement. What I'm going to do is I'm going to give you an option fee of, say, $5,000, and that is going to help me reserve the property for, say, 6 months. And during those 6 months, I'm going to save up money for the down payment and pay you then. So during this time, you're also going to be operating out of the space. You're going to be using it for whatever. Let's say you had a candle business. You're going to be selling candles and saving up money in that 6 month period. You're going to pay the landlord rent. And now 6 months down the road, when you're ready, you're telling the owner or the seller, say, hey, I got the moolah. Let's go. Let's complete the purchase. And last but not least, we have broker agreements. This is a document that's going to outline the terms between you and a real estate broker. It's going to give information on how the broker is going to represent your interests. It's typically going to cover some details here. It's going to probably say that the broker is going to be responsible for marketing the property. They're going to find potential buyers for you or renters if you're looking at leasing up space, and they are going to be the ones negotiating for you. They're going to try to secure the best terms for you on a lease or sale, and they're going to do all the necessary paperwork to guide you through the closing of that particular deal. And lastly, they're there for your best interest, and they're going to state that they're there to ensure your best interests are prioritized. And it's also going to specify their compensation, which is usually a fixed fee, or it could be a percentage of the sale price or rent, or it could be a combo of all of it. Once again, creativity is the limit here. And a value tip for you guys, sometimes with larger brokerages, you can try to negotiate a flat marketing fee if you source your own tenants. This way, you can avoid some of the commission that they would get on the base rent of those tenants, thereby saving you some money. And that's a wrap for today. I hope this summarizes it well for you. I hope you understand them a little bit more clearly. And until next time, Wonton out.